If your business grows fast, chances are you'll need funding, maybe a bank loan, an overdraft facility, or perhaps machinery financing. But how much is too much? In this module, we explore the concept of gearing, the balance between your own capital and borrowed funds, and how it affects your business's financial health and bankability. Learning outcome. By the end of this module, you'll understand what gearing means, how to calculate it, and why a healthy gearing ratio is important when applying for bank financing. Part 1. What is gearing? Gearing refers to how much of your business is financed through borrowed money compared to your own money. Note: for the purpose of this learning, gearing will centered on bank borrowings instead of total liabilities. It answers this question: how much are others, banks or lenders, supporting your business versus how much are you supporting it? The gearing ratio is typically calculated as total external borrowings divided by total equity, where total external borrowings equals all the debts and loans you owe. Total equity equals the capital you or your shareholders have put in. Part 2. Example of gearing ratio. Let's say your company has 300,000 ringgit in loans and debts, total borrowings, 100,000 ringgit of your own capital, total equity. Your gearing ratio would be 300,000 divided by 100,000 equals 3 times or 300%. That means for every RM1 of your own money, you have borrowed RM3. This is considered high gearing, and to banks, it may signal financial risk. A gearing ratio of above 1.0 indicates that the business is funded more by debt versus equity. Many banks and lenders will set a gearing covenant to ensure businesses do not overborrow. For MSMEs, the threshold is about 2.5 to 3 times gearing, which is usually imposed as a condition by banks and lenders. A lower ratio gives banks more confidence that your business can survive a downturn and still repay the loan. Part 3. What happens if gearing is too high? If you borrow too much, you may struggle with repayments during low sales months. Your business may rely too heavily on external cash. Banks may reject your financing application. It's important to show that you've also invested your own money. It demonstrates commitment and lowers their risk. Part 5. Tips to improve gearing. Inject more equity. Add your own savings or reinvest profits instead of withdrawing. Reduce unnecessary borrowing, especially short-term loans for long-term assets. Improve profitability. A higher profit base increases retained earnings, and thus equity. Convert short-term loans to longer-term debt. This reduces monthly pressure and improves cash flow. Mini activity. Pull out your latest balance sheet or financial report. Check. In your liabilities, look out for bank borrowings. Total all your bank borrowings. Then look out for total equity. Use the formula. Gearing equals total bank borrowings, total equity. Are you above 3 times? Summary. Gearing shows how dependent your business is on borrowed money. High gearing might give you growth in the short term, but banks may see it as high risk. Maintain a healthy balance between equity and debt to boost your chances of loan approval. In the next module, we'll talk about a common business mistake, confusing profit with cash, and why cash flow is king.